Good afternoon, everyone, and thank you for being here. My name is Kyle Skinner, and today I'm going to be going over my equity recommendation summary on FUBO. Firstly, let's note that as of April 4th, the closing stock price was $2.80, and our 12 to 24 month price is $6. So, jumping into a general business slash industry comment, FUBO is a sports focused live TV streaming platform that offers subscribers access to live sports, news, and entertainment content through internet connected devices. The company operates a subscription-based direct-to-consumer business model, generating their revenue primarily through monthly subscription fees and advertising sales. FUBO serves over 2 million subscribers across the United States, Canada, and parts of Europe. Its end markets include sports fans, cord cutters, families, and tech-savvy consumers seeking alternatives to traditional cable TV. In 2024, 93% of its $1.59 billion revenue came from subscriptions, with the remaining 7% coming from advertising. And between the premiums paid and the ad revenue that FUBO collects, the average revenue per user is currently $87.90 a month. So with this, we will jump into our industry comment saying that the live TV streaming industry is characterized by intense competition, rapid technological change, and significant investments in content and technology. For example, from 2022 to 2024, the number of US households that have cut the cord has gone from 27 to 46%. And by 2026, that number is expected to reach 72%. So with this being said, we will jump into our summary financial metrics, and I would like to lay a foundation out with some key points before jumping into our free cash flow assessment or justification. So I'd like to start by saying these financial metrics are assuming that the deal with Disney goes through within the next 12 to 16 months. Additionally, the summary financials explode in 2026 primarily because I predict that this is when FUBO and Hulu, the merge, we'll start to see the rewards for the merge at this time. Additionally, FUBO could experience even higher revenue jumps if their revenue is combined with Hulu, but since the specifications are unclear, I assumed FUBO would obtain 1.5 million new subscribers at a minimum. The average revenue per user would jump to $150, and I calculated them receiving a 7.5% revenue gain from increase in advertising. And so with this being said, the sports wagering profits aren't even calculated in these financials due to the legal and licensing issues that could take years to approve. And so overall, I believe my forecast is still very conservative since FUBO has so much potential to break into so many markets, such like we just said, the sports wagering, the subscription combination, and their advertising. So with this being said, we'll jump into our free cash flow assessment, starting with the fact that they've always had a negative free cash flow due to focusing on subscriber acquisition and content. However, these financials are showing us that this will improve significantly over the forecasted period. So notably, their free cash flow turned positive, free cash flow per share turned positive for the first time ever in Q1 2024 at 49 cents on the dollar. And I believe this trajectory is going to continue, and it's driven by several factors, such as the anticipated revenue growth fueled by the potential Disney deal, where Disney will gain 70% ownership and FUBO will be merged with Hulu plus Live TV, totaling over 6 million subscribers. I expect this to generate increased cash from operations by almost slash at least 2x. Additionally, the potential of entering into the sports wagering and untapped advertising market could give FUBO a significant cash boost on top of the newly added subscriptions. So with this, we will jump into our purchase justification, and I wanted to touch on just the two biggest justifications for me, starting with the Disney deal and the potential subscriber growth. So the excitement of this news alone drove the stock price up over 200% in one day in January 2025. And this combined entity would become a major player in the live TV streaming sports market, potentially attracting more advertising revenue and achieving greater economies of scale. Moving on to, and the second largest purchase justification I wanted to mention was their content leadership and their sports focus. So they differentiate themselves with their strong focus on the live sports content. This Disney deal would further enhance its content library, adding a wider range of sports and entertainment programming. And so I want to mention that Venue, who is Disney's planned joint sports streaming service, essentially has halted operations after the judge started to rule the case in FUBO's favor back in 2024. And so clearly Disney has plans with FUBO and sports streaming and sports wagering. It is just difficult to tell what and when those will be achieved. And so with that being said, we will talk about their global impact. As mentioned earlier, 80% of their subscribers are in the United States, highlighting how crucial it's going to be for them to capture this market. However, they are expanding their international presence. They've launched in Canada and Spain, trying to target their specific sports fans audience in those regions. And so ultimately, their ability to secure attractive content deals in different markets will be crucial for their success. And so I'm going to do a similar thing for the risk factors. I just want to touch on the two biggest ones, starting with the competition. These large, well-funded companies such as Warner Bros., Google, Sling, YouTube TV, they're all very capable of doing their own partnerships and strategic deals themselves. And on top of this, they could put pressure on pricing, subscriber acquisition cost, and just overall profitability. And so this leads into the other risk, which is the Disney deal not going through. And I mean, any disruption or negative change in these terms across these partnerships will negatively impact FUBO. The risk with the deal alone is if the deal is not completed, we have a $130 million termination fee, which would not be good for FUBO. On top of that, integration challenges could arise if the deal closes and the anticipated benefits of the deal aren't realized until years later. And so with this being said, we're going to move into our valuations. So starting with our current valuations off of the 2024 estimates, the multiples reflect the company's growth potential in the live TV streaming market and the anticipated benefits of that Disney deal. Compared to its 52-week low, the stock is up 120% from its 52-week low and down 60% from its 52-week high, presenting a high risk, high reward entry point given their growth prospects and potential catalyst ahead. The downside risk is that we could see the stock price decline to around $1.50, which could occur if the deal fails to close. Subscriber growth falls significantly short of expectations. Another risk is the overall market just experience a prolonged downturn, especially impacting growth stocks. This downside scenario reflects a very conservative view of FUBO's execution and market conditions with the potential for financial distress. On top of it, FUBO does have $144 million of debt maturing in 2026 and around $200 million in 2029. So this deal is a major catalyst for them. Now, upside potential, our upside scenario, we see the stock price reaching as high as $8, which is an 167% increase. This upside case is based on the fact that the deal goes through and that they establish a dominant position in the live TV streaming market, leading to their premium valuation and positive investor sentiment towards them. And lastly, I just want to mention that FUBO has no debt maturing in 2024 and 2025. And so with all this being said, let's take a look at our industry comparison. And the Bloomberg classified it as internet media services comp. So some of these companies might not look like direct competitors, but they are classified as the internet media and services comp. And I have some key points to highlight really quick before I wrap things up here. That there's significant upside. It's 52-week low. There was a major spike after their Disney announcement in January 2025. They've reported their first positive cash flow in Q1 2024 since their IPO. And when we compare the gross margin and operating profit margins across competitors, FUBO has a significant upside potential, and there should be a significant increase in net ROE over the years due to the deal being closed, debt being paid off, and revenue increasing. Debt to equity is significantly high compared to competitors, which should level off in the upcoming years. And the price to free cash flow suggests that FUBO is undervalued in general. So with that being said, that is all I have, and thank you for your time.